Welcome to Navigating the Tides, where we unravel the powerful, often invisible forces shaping Australia's economic landscape, particularly for the backbone of our economy, the small business owners and freelancers managing their vital cash flow. Today, we're delving into the intricate dance between interest rates, the evolving private rental market, and global supply chain trends, all converging to create a unique set of challenges and opportunities. Australia finds itself at a fascinating macroeconomic juncture. After a period of historically low borrowing costs, we've observed a significant recalibration. This shift sends ripples through every sector, from the largest corporations to the smallest sole traders.
Indeed, Adam. The official cash rate, a foundational element in our financial system, has seen a series of adjustments over the past 2 years. This directly influences variable lending rates across the board, impacting everything from mortgage repayments for property owners to lines of credit for businesses. For instance, a small business with a $150,000 operational loan, initially secured at a 4.5% interest rate, might now be looking at rates closer to 8.5% or even 9%. This isn't just an abstract percentage point. It translates to hundreds, if not thousands, of additional dollars in monthly expenses.
Ben's absolutely right. Take my friend, Sarah, a freelance graphic designer based in Melbourne. For years, she's operated her business out of a dedicated home office, renting a 2-bedroom apartment. Her landlord recently informed her of a 15% rent increase upon renewal. Her rent, which was already $2,200 a month, is now jumping to $2,530. That extra $330 isn't discretionary. It's a fixed cost she needs to cover before she even buys a coffee or pays for software subscriptions. For a freelancer like Sarah, who might bill between $6,000, $8,000 in a good month, that $330 eats directly into her profit margin, effectively reducing her net income by 4 to 5% just from that one line item. It forces a reevaluation of her pricing, or a search for a cheaper, potentially less suitable workspace, which could impact her productivity and client perception.
That example powerfully illustrates the immediate, tangible pressure. We're also observing a broader conversation around asset access within the Australian private rental market. Reports highlight how the increasing cost of entering the property market has created distinct experiences for different generations.
From an institutional perspective, the Australian housing market has indeed displayed robust growth in asset values over the past decades. This trend, while beneficial for established asset holders, presents a formidable barrier for newer market entrants, including many aspiring small business owners and freelancers. It means a significant portion of younger entrepreneurs may spend a larger percentage of their income on rent, limiting their capacity to accumulate capital for business expansion or personal wealth generation.
The current state, therefore, is one of heightened financial sensitivity. Every decision, every market shift reverberates through the operational viability of countless Australian ventures. To understand the present, we must examine the underlying structural drivers. Beyond interest rates, global supply chain dynamics continue to exert substantial influence on operating costs.
Our analysis of Australian trade data reveals persistent, albeit moderating, volatility in global logistics. Shipping container costs, while off their peak, remain elevated compared to pre-pandemic levels. We still see occasional delays at major ports, which cascades into production schedules and inventory management for businesses of all sizes. For example, a cafe relying on imported specialty coffee beans might face extended lead times, forcing them to hold more stock, tying up cash, or risk running out, leading to lost sales.
I've seen this firsthand with my cousin, Mark, who runs a small online store selling handcrafted Australian-made leather goods from Perth. He sources specific buckles and hardware from overseas suppliers to ensure quality and uniqueness. Last year, a batch of unique clasps got held up for an extra 3 weeks due to port congestion. This meant he couldn't fulfill pre-orders on time. He had to offer customers a 10% discount for the delay, costing him approximately $300 on those particular orders. More importantly, he had to pay for expedited shipping for subsequent batches, which added an extra $80 to his usual $200 freight bill per shipment. Over a year, if this happens even once a quarter, that's an additional $320 in unexpected freight costs, plus the loss from discounts. For a business with tight margins, these seemingly small, cumulative increases in input costs and shipping fees can genuinely erode profitability, turning a modest profit into a break-even or even a slight loss on certain product lines.
From an institutional perspective, larger enterprises often possess the economies of scale and contractual leverage to mitigate some of these supply chain fluctuations. They might have diversified supplier networks, long-term freight agreements, or significant warehousing capacity to absorb temporary disruptions without immediately passing on costs. Smaller businesses, however, are frequently more exposed, often reliant on spot rates for shipping or single-source suppliers, making them more vulnerable to price increases and logistical challenges.
This highlights a critical dichotomy. The robust nature of the macroeconomy often masks the fragility experienced at the micro level. The mechanisms driving higher interest rates also contribute to this complexity.
The persistent upward trajectory of core inflation metrics, influenced by both demand-side pressures and cost-push factors from supply chain disruptions, has been a key driver. Central banks, globally and in Australia, have responded by adjusting interest rates to manage these inflationary pressures, Ming for a more stable economic environment. This strategy, while designed to curb inflation, inherently increases the cost of capital, affecting both consumer spending and business investment decisions.
The macroeconomic currents we've discussed create notably different experiences across the Australian economic landscape. We see a significant divergence between how large institutions navigate these conditions and the reality for small business owners and freelancers.
For established financial institutions and large corporations, managing interest rate adjustments is part of their inherent risk management strategy. They often have access to a broader range of hedging instruments, sophisticated financial modeling, and diversified revenue streams, which allow them to absorb or strategically pass on rising costs. For instance, a major commercial property developer might have fixed-rate financing for substantial projects or the capacity to secure new funding at competitive rates due to their strong balance sheet and credit rating. They can plan for longer investment horizons, anticipating market cycles.
But for someone like David, a sole trader carpenter in regional Queensland, this institutional buffer simply doesn't exist. He relies heavily on a flexible business overdraft to manage cash flow gaps between project payments and material costs. His overdraft limit is $25,000, and the interest rate has climbed from 7% to 12% in the last year. If he uses an average of $10,000 for 3 weeks each month, that's an extra $80 in interest per month, or roughly $490 a year. While that might not sound huge, for a small business, that $490 is money that could have been reinvested in a new tool, spent on marketing, or simply contributed to his family's savings. It's an erosion of the financial flexibility he needs to thrive. Moreover, if project payments are delayed, that overdraft usage extends, amplifying the interest burden.
This brings us back to the observation about wealth and age influencing financial resilience. Those who have accumulated assets over time, perhaps through earlier property ownership, find themselves in a different position compared to newer market entrants.
Absolutely. Asset class performance demonstrates a clear historical pattern. Individuals with established portfolios in property or diversified financial instruments are generally better positioned to weather periods of economic adjustment. Their existing equity can serve as collateral for business loans at more favorable terms, or provide a financial safety net during periods of reduced cash flow.
That's the core of it for so many freelancers. My friend Emily, a social media consultant, exemplifies this. She's in her late 20s, has been freelancing for 5 years, and rents a small studio in Sydney for $700 a week. She meticulously saves for her business, but every dollar she puts aside for a professional development course or new software needs to first cover her escalating living costs. Compared to someone a generation older who bought a house decades ago for $150,000 and now has significant equity, Emily's ability to generate seed capital for her business or personal savings is intrinsically tied to her incredibly high rental burden. She feels like she's constantly playing catch-up, with less disposable income to invest back into her professional growth or to create a robust financial buffer for her business.
Data on household savings rates across different age demographics corroborates this. Younger cohorts, particularly those without substantial asset ownership, tend to have lower discretionary savings. This limits their ability to absorb unexpected business costs or personal financial pressures, making them more sensitive to interest rate movements and rental market shifts.
Looking ahead, the economic landscape continues to evolve. While predictions are inherently complex, understanding the likely trajectory of interest rates, rental structures, and supply CHNs is crucial for strategic planning.
Current projections indicate a period of continued vigilance from central banks regarding inflation. While the pace of interest rate adjustments may moderate, the expectation is for rates to remain at levels higher than the historical lows we saw in previous years, at least for the foreseeable future. This suggests that the cost of capital will remain a significant consideration for Australian businesses.
From an institutional vantage point, this sustained higher interest rate environment encourages a greater focus on efficiency and disciplined capital allocation. Corporations are likely to prioritize investments with clear, measurable returns and robust risk profiles, potentially favoring automation or technological upgrades that enhance productivity. For smaller businesses, this means demonstrating strong business cases, and cash flow visibility will be paramount when seeking financing.
For a small business owner, say, a local bakery in Adele Day, understanding this means rethinking their equipment upgrade cycle. Instead of replacing a mixer every 5 years regardless of cost, they'll need to run a detailed cost-benefit analysis. If a new $15,000 mixer financed at 9% interest will save them $200 a month in labor or waste, they need to compare that directly to the $150 monthly repayment and decide if the net GN of $85 is worth the increased debt exposure in a higher interest rate environment. It demands a much sharper focus on return on investment for every operational expenditure.
And what about the private rental market? Will the pressures on affordability persist?
The underlying dynamics of supply and demand in the rental market suggest continued upward pressure, particularly in major urban centers. Factors such as population growth, coupled with the pace of new construction, contribute to this structural imbalance.
Institutions are observing sustained demand from both domestic renters and investors. This indicates that competitive rental conditions are likely to continue, meaning small businesses and freelancers who rent their premises or homes will need to factor in potentially higher occupancy costs into their long-term financial models.
This means my friend Sarah, the graphic designer, needs to budget not just for this year's rent increase, but to build in a buffer for future potential increases when negotiating new client contracts. She might add an extra 2 to 3% to her hourly rate for new projects, or bake in an annual review clause, specifically to absorb these predictable escalations in her cost of living and doing business. It's about building resilience into her pricing strategy.
Finally, on supply chains, are we heading towards greater stability or continued fragmentation?
While the extreme disruptions of recent years have largely eased, the global landscape remains subject to various factors, including geopolitical developments and environmental impacts. Businesses should anticipate occasional, localized disruptions rather than a complete return to frictionless pre-pandemic efficiency.
This translates to a strategic imperative for diversification. Institutions are investing in regional supply hubs and exploring localized sourcing options where feasible, reducing reliance on single geographic points. For small businesses, this might mean identifying secondary suppliers, even if they're slightly more expensive, to mitigate the risk of a single point of failure.
The macroeconomic currents shaping Australia are powerful, complex, and deeply impactful, especially for those navigating the critical turn of small business and freelance cash flow. Understanding these trends, from the sustained cost of capital to the pressures of the private rental market and the nuances of global supply CHNs, isn't just academic. It's essential for strategic foresight and resilient business planning. And thank you for joining us on Navigating the Tides. We hope this deep dive equips you with insights to chart your course with confidence.